Wait, let's unpack this. We've done it. We have officially turned the page, waving goodbye to September, the market's perennial headache. And now we're sailing straight into the notoriously bullish waters of Q4.
Yeah, the timing here is pretty compelling. We're drilling down into the weekly market action, the week ending Wednesday, October 1st, 2025.
Right.
And our mission today really is to sort of reconcile the central paradox driving the market right now.
Which is?
Well, you've got the S&P 500 hitting record highs, but at the same time, you have genuinely weak, deteriorating employment data.
Okay, so that tension, what does it tell us about the trajectory for the rest of the year?
Exactly. That's the key question.
We're definitely going to hit those crucial macro data points, but the headline story we really have to focus on is the sector that delivered this, extraordinary high-volume breakout this week, healthcare.
Yeah, absolutely. We need to understand the implications of this leadership shift, especially given, like you said, the S&P seems to have just shrugged off all those previous worries.
Okay, first, though, maybe just a moment of appreciation for September 2025.
Yeah.
Because historically, it's the worst month.
Oh, yeah, the absolute worst. It's the only month where the S&P actually goes down more often than it goes up, historically speaking.
And yet this year, we finished the month up. The market really proves its resilience there.
It really did. And that resilience, it sets the perfect foundation for that seasonality shift you mentioned. For you, the listener, the single most important time frame historically. It runs from the close on October 27th right through January 18th.
Okay, mark that down. October 27th to January 18th, yeah.
Yep. If you look at the data going all the way back to 1950, that period represents the most bullish stretch of the year. And that confidence, you can feel it. It's baked into market expectations right now.
But the engine driving these expectations, it's kind of weird. It's the weak economic data, right? Specifically, this jobs dilemma.
That's the paradox.
This week, we saw the ADP employment report print negative. And we're still the August ADP number, which was already weak.
Got revised down, negative as well.
So that's 2 consecutive months of negative private sector job growth.
Wow, yeah. And while the big one, the non-farm payrolls report, the NFP, hasn't crossed into negative territory yet, it has been trending below that kind of crucial 100,000 jobs mark since May. So the trend is definitely soft.
Which raises that important question. Why are stock indices hitting records if the economic foundation looks like it's softening?
And the answer is, well, it's counterintuitive, but it's almost universally accepted now by the market.
Okay.
Weak employment numbers are seen as an absolute, ironclad guarantee for future rate cuts.
So the market isn't panicking about a recession.
No, not at all. It's confidently pricing in a Fed that will cut rates. Probably November, December, and certainly more throughout 2026.
Got it. So bad news is good news because it means cheaper money is coming.
Exactly. The narrative isn't recession panic, it's policy shift certainty. The market believes the Fed's going to act preemptively, ensure that soft landing, and weak data just removes the if, it becomes about the when.
Okay, let's talk about the results of that certainty then. Market performance, Wednesday to Wednesday close.
NASDAQ Q100 gained 1.2%.
Nice.
S&P 500 was up 1.1%.
Also solid. But interestingly, transportation stocks, they lagged again, didn't they?
They did, once again. And that lagging transportation sector, it's a crucial canary in the coal mine, something to watch. But the headline technical milestone is still pretty impressive.
The S&P.
Yep. The S&P 500 closed above 6,700 for the first time ever, landed at 6711.2.
Wow, 6,700. And considering the market suffered that really quick 20% drop of cyclical bear market earlier this year,
right,
the speed of this recovery is, unprecedented, really.
It's been quite the V-shape.
Now, you had an original year-end target of 7,000 for the S&P. Is that still on the table? Or are you getting concerned that these lagging transports and weak jobs might apply the brakes?
That target, it remains achievable purely because that policy expectation, the rate cut expectation, is just so strong.
Okay.
But you raise a vital point. We need participation. We need breadth.
And are we seeing it?
Well, the NASDAQ Q100 is also cruising, hit a new record high at 20,4,800.
Oh.
Small caps, the IWM, they're lagging a bit, but they are showing resilience. They're holding above their rising 20-day moving average.
So they're close.
They're right there. They only need maybe 1.5% to 2% more to officially break their own highs. So close.
Wow. Okay, so here's where the chart tells a really compelling story, though.
Yeah.
The leadership change. Technology, continued strengthening, up over 2%.
Still strong.
But the other 3 leading sectors this week, they were defensive groups. And the one that staged a true technical pivot was healthcare.
Yeah, that rush into healthcare, the XLV ETF, it was dramatic. Gained more than 5% in just 5 trading days.
Wow, over 5%.
This isn't just, minor rotation. This feels like a capital commitment.
Let's focus on that XLV move then. Over 5% in a week, mostly within just 2 trading sessions.
Yeah.
You mentioned this represents a huge technical shift on the long-term charts.
It really does. If we connect this to the bigger picture, look at the 5-year weekly chart for XLV. The healthcare sector broke out of this really well-defined, longer-term downtrend channel, a channel that had persisted for like 13 long months.
13 months. That's a major resistance level being decisively overcome.
Absolutely.
But breaking a 13-month downtrend on a defensive sector, that feels a bit contradictory, doesn't it? I mean, while it broadens the rally, which is good, doesn't a major shift into healthcare also suggest that maybe savvy investors are quietly bracing for some economic uncertainty ahead?
It absolutely suggests caution. You're right. Which is why this breakout is, let's say, nuanced.
Okay.
It's positive because it does broaden the market. We want beaten down sectors to improve their charts, right?
Right.
But it also tells us money is moving maybe from the purely aggressive growth areas toward, quality defensives. But the strength itself was confirmed by a couple of key technical signals.
And what were those? For the listener who might not be looking at charting tools every day, what technical confirmations are crucial here?
Okay, 2 things. First, we saw the weekly PO, that's the price oscillator, turn positive. Okay, more crucially, the weekly RSI, the relative strength index, moved above 60 for the first time in that entire 13-month period.
RSI above 60. And why is that significant?
Well, the RSI measures the speed and change of price movements. When it moves above 60, especially after being below it for so long, it indicates that momentum has clearly shifted back into the buyer's favor. This breakout isn't just random noise, it's backed by accelerating technical strength.
Gotcha. And drilling into the components who actually delivered this surge within healthcare.
Okay, so pharmaceuticals jumped 9.3%. Huge move.
Wow, 9.3%.
And biotech wasn't far behind, jumping 8% in that single week.
8%.
And biotech is now sitting at an 11-month high. It's really pushing towards its 52-week high. These are groups that were lagging for, years sometimes, now showing explosive short-term strength.
Okay, that brings us to our shortcut then. With this much money flooding into healthcare, how do we find the individual stocks that are powering this tsunami? We turn to the SCTR, right? The stock chart's technical rank.
Yep, the SCTR, sometimes called the Scooter score. It measures a stock's relative strength against its peers. It's a great starting point.
But it has a limitation.
It does, and it's important. It only looks back 5 months.
Okay. And why is that 5-month look back important for our strategy here? Why not longer?
Because it ensures we're identifying stocks that have recently turned the corner. We aren't just chasing the performance leaders from 2 years ago,
All right.
We're looking for the names that are just starting their significant positive change now.
And the evidence this week using that SCTR filter was, well, pretty overwhelming, wasn't it?
Completely overwhelming.
Yeah.
When you filter for large cap stocks that had the largest positive change in their SCTR score over the last week, 8 of the top 8 names were healthcare stocks.
8 out of 8.
And 12 of the top 13 were healthcare. The capital flow is just undeniable.
Incredible. Okay, let's put some names to these charts then, starting with maybe the biggest reversal stories.
Okay, but before we do, let's quickly introduce one more technical concept we'll be mentioning, the advanced decline line, or AD line.
Right, the AD line. What exactly does that tell us again, quickly?
It's actually pretty simple. It measures the breadth of a market move, whether it's the whole market or just a sector or even a single stock's internal momentum.
How does it work?
It tracks the cumulative difference between the number of advancing stocks versus declining stocks for an index, or just compares price action to volume flow for a stock.
Right.
If the AD line is making new highs along with the price or even ahead of the price, it tells you the rally is broad and healthy. It's not relying on just a few big names. It confirms participation.
Perfect. Okay, AD line confirmation. Let's look at the reversal plays first.
All right, the absolute star here, I think, is Pfizer, PFE. It's been downtrending for a very long time, but the chart is truly eye-popping right now.
Oh, yeah. What's that there?
It just broke out of a massive bottoming head and shoulders pattern.
The classic head and shoulders bump.
Yep. And crucially, on truly extraordinary volume, huge volume.
Okay, for our listener, the head and shoulders is maybe the most famous reversal pattern. Give us the 20-second summary of why this specific pattern is so historically significant for reversing these long-term trends.
Sure. Think of it as 3 failed attempts by the sellers to push the price lower. You get the shoulders and the lower head in the middle,
Right.
representing those failed pushes. But the pattern completes when the stock breaks decisively back above the resistance level, the neckline. In PFE's case, doing it on huge volume just screams confirmation.
So it signals the sellers are exhausted.
Exactly. The long-term trend of selling pressure has exhausted itself, and the bulls have taken over completely. And the minimum measured move, just based on the pattern's size for PFE, suggests a potential run up to around $32.
Okay, $32 target on Pfizer. That's a pivotal technical shift for a major pharma stock. Let's move to new high breakouts and consolidation plays.
Right. We saw some strong consolidation breakouts, too. Look at Johnson & Johnson, J&J.
Okay, J&J.
It broke out of a bull flag consolidation pattern coming off an uptrend. And for such a big defensive name, the potential target range calculated from that flag is around $200 to $210. That's a significant move for J&J.
Definitely. Okay, what about companies confirming existing uptrends?
Yeah, Icon PLC. ICR. It broke out above a triple top resistance area on heavy volume.
No.
Looks like it has the potential now to challenge its recent high around $210.
Okay, ICR.
Similarly, IQV. It made a breakout above the high close from a couple of months back. And critically, its AD line, that breadth measure we talked about, it's now getting to a new high as well. That confirms broad participation in IQV's move.
Good confirmation. What about in biotech specifically?
Well, Biogen, BIIB, made a big move, staying in a strong uptrend that started back at its April low.
Okay.
And then there's AbbVie, ABBV. It's consolidating nicely right now, just digesting a prior breakout. But its AD line is already securely at new highs. That tells us the underlying rally in AbbVie is structurally pretty sound.
All right. And maybe one smaller name?
Sure. In the smaller pharma space, look at AGO. Interesting chart. Its AD line just set a 52-week high, even while the price is still challenging a breakout area around $41.
So the internals are leading the price.
Exactly. If AGIO can get a solid close above $41, you could see a strong potential run into the, say, $60, $62 area based on that setup.
Okay, lots of action in healthcare. We can't ignore the rest of the market. You flagged 3 major non-healthcare movers that show maybe the risk-on attitude is still alive and well, too.
Yeah, definitely. First, Tesla. TSLA.
Always Tesla.
Right. It broke out of a symmetrical triangle pattern and, importantly, with volume confirmation. This move looks like it's setting up to challenge the all-time high, which is closer to $500, really leveraging that tech enthusiasm.
Okay, TSLA aiming higher. Who else?
Then there's Olin, ONL Corp. This one showed really excellent resilience. It pulled back perfectly to a prior double top breakout area, held it, and is now starting to move back up again.
Nice retest.
Yeah, a classic retest. And its 80 line is showing strength too, hitting a 10-month high.
Good sign. And the last one, a small cap.
Yep, a small cap play where volume really confirms the story. Clean Spark. CLSK.
CLSK.
This one made a breakout above its recent highs. That's around the $13 to $13.50 range, and it did it on a very big volume.
Volume is key there.
Absolutely. The first step potential for CLSK based on that breakout is likely up into the $17 and $15 to $18 range.
Okay, we have covered so much ground here. It feels like the market isn't just surviving, it's firmly in that seasonally bullish period we talked about.
Used that way.
And this exceptional high-volume move in healthcare, it really confirms that significant, maybe crucial technical shifts are underway, broadening the rally beyond just those mega-cap tech names.
Absolutely. That broadening is key. The short-term focus, however, has to remain entirely on that non-farm payrolls report coming up this week.
Right, the NFP, because remember the paradox.
Exactly. The ideal outcome for the market right now is actually a low positive number. Not too hot, not negative, just weak enough.
Goldilocks, but on the weak side.
Pretty much. That weak but not recessionary data point just reinforces the narrative of inevitable Fed rate cuts. And that's the precise fuel the market seems to want to lift strongly into year-end.
Okay, so here's a final provocative thought for you, the listener, to explore this week. Consider the profound power of volume when it combines with a clear reversal pattern, like that bottoming head and shoulders we just discussed in Pfizer. Is this high-volume reversal in defensive names like PFE, maybe the leading indicator that the policy shift, the one that weak jobs data basically guarantees, is finally being aggressively priced in by the big institutional money?
It's a fascinating question.
Keep a very close eye on PFE and that potential $32 target we mentioned, and ask yourself, how quickly can a multi-year downtrend really pivot when the technical stars align with the macro narrative? Happy analyzing.